All right. I hope you all enjoy your coffee break. My name is Gustavo Tella, and I'm going to be moderating the panel today. You probably remember me from last year's event when we actually had a very different panel where we were talking pretty much about credit analytics and credit models and how to potentially expand the assessment of country risk and counterparties back then. So today we have a very different agenda, a very much more of a macroeconomic approach, so combining not only interest rates and reserve Fed funds, also global commodities experts in the room. And we also have a practitioner today joining us, Jerome from HCC. So I think it would be a great start for us for the moderating panel to let Jerome introduce himself for about 5 minutes, so if I can ask for that. And also for you to think about, what do you think were the best takeaways from this morning session. And while Jerome is probably preparing himself, I'd like to ask you again to submit your questions through the iPad. It's super easy to do. At the very top of your iPad, you have a Q&A button. As you click on that Q&A button, you can submit your questions. Those questions will come to my iPad, and then we can pass it over to the moderators today, or the panelists. So remember that the better the question, the better I look. So please make an effort to ask good questions and difficult questions. So let's start. Jerome, over to you.
Thank you, Gus. So I'm Jerome Swinscoe. I'm an underwriter with HCC. HCC is a specialty insurance company based in the US. We're listed on the New York Stock Exchange. The company is not one of the largest insurance companies. We're a medium-sized company. The market capitalization of the company is about $5.5 billion. Just to set the scene, I'll explain a bit about what we do and what some of the key aspects of what we take into consideration are. Just maybe to explain specifically what my focus is as an underwriter, I'll come back to one of the points Jean-Michel was making earlier today when talking about the global interest rate environment and the impact it might have on a variety of different players in the financial market, including the impact it might have on insurance companies. I'd just like to say that what I'll be speaking about today, and in terms of the questions you might have, my focus will be really more on the underwriting side of things. You probably know, for those of you who work for insurance companies, that an insurance company makes money in two different ways, and the focus will be more or less on one or the other sides, depending on what the strategy of the company is. For HCC, the idea for us is to make money mainly from underwriting, and so the vast majority of our profit is derived from underwriting. That means that people like me will focus on different areas of insurance and try to manage portfolios of insurance risks and insurance policies to generate profit. The other side of the medal is to make money from asset management and investments, and that's where the interest rates come into play. So for HCC, interest rate movements are not as important as they would be for insurance companies that focus more on asset management than we do. But that said, it is a very important factor, and a change in interest rates of only 10 to 25 bips in the US would have a major impact in terms of an increase in our profitability, even though, as I just said, the focus for HCC is more on the underwriting than on the asset management. So that said, maybe I'll just say a few words about our insurance portfolio and about how things have developed for us over the past few years. Just to be very clear, what my team does is that we focus on political risk and credit risk insurance. The idea there is to cover companies, whether they're corporates or banks, against the risk of a loss that would be triggered by either a non-payment, a credit default event, or any event that might be of a political nature that could have a financial impact on a company. So looking at who we deal with, things have changed a bit over the past few years, and until the crisis towards the end of 2007 and 2008, a very big source of business for insurers in our line of business was from banks, and it was to do with structured trade finance in particular. That has changed recently, and it has changed due to one of the points that Jean-Michel was making earlier as well, which is to do with deleveraging. And the deleveraging impact on banks has been quite stringent for some of the traditional banks we were used to dealing with, namely a bank like BNP Paribas and other French banks that had big exposures to emerging markets, to more tricky risks, and they were asked by their boards to reduce the exposures they had to these sectors. So that has meant that we're about 40%, if not more, of our business was derived from bank insureds 6 years ago. This now represents about 28%, so it has reduced a lot. Looking quickly at the countries we have exposure to, traditionally we focus more on emerging economies than on developing economies. And focusing on emerging economies, well, you would probably expect that we would have substantial exposure to BRIC countries, and that was the case, again, until quite recently. So the share of BRIC countries in our portfolio 5 or 6 years ago represented close to 35%. This is now down to less than 20%. The reduction is really a proportional reduction in dollar terms. The exposure we have to the BRIC countries remains the same, but as our portfolio has expanded, proportionally it has reduced. In terms of the nature of the risk we're taking, we have recently seen a bit of a deterioration in the risk rating of the countries we are involved with. So we have around 40% of our exposures, if between 40 and 45% of our exposures in BBB rated countries, but we have around a third of our exposures in BB rated countries or lower. And recently the portion of the lower rated countries has increased due to a deterioration in overall ratings of these slightly weaker countries. This is something we have seen particularly in the first quarter this year. We monitor rating changes, and that has an impact on our portfolio. In the first quarter, out of all the countries we handle, we had 1 upgrade and we had 10 downgrades. So the picture is not looking that great. So that's for the countries. Looking at the sectors, a lot of the business we do is related to commodities, and oil and gas in particular. And following up on what Jorge was saying earlier today, well, we all know where oil prices are, and that can have a positive impact. And both of the presentations suggested that there is a positive impact, in particular on consumers. But what we tend to focus on is on producers. And so for us, again, things can be a bit tricky. On the other hand, we do have sustained demand, and the percentage of the oil and gas exposure in our portfolio that represents around, I think, 20 to 25% has remained relatively stable. Part of that is because we deal with commodity traders, and commodity traders benefit from the contango effect that was described earlier. As a result of that, there is a lot of volume, but volume that can be tricky in some cases. And the last trend that we have observed over the past 12 months, 24 months, is an increase in demand for the coverage we provide on a more medium to long-term basis. And that results in a variety of challenges for us on the underwriting side, because it means that we can no longer afford to underwrite business on a short-term basis with a short-term focus, but everything we do has to take into account what might happen over a horizon of 5 to 7 to 10 years potentially.
Thanks for the introduction there. So let's start with a question that goes from micro to macro level, right? So let me bring this FT comment from Petrobras. So Petrobras, as you know, the national oil producer for Brazil. It's been dubbed by the Financial Times as the perfect storm, because here we have an oil company in the emerging markets with government subsidies at the heart of its commercial model, going through political fraud, scandals, with no access to credit market until you can release audited results, which no one, by the way, wants to do. So we have emerging markets, oil prices, political scandal risk, accounting risk, all in one place. What are the lessons that can be learned from a risk perspective from this story? And how can underwriters protect themselves from similar situations in the future? I guess we can start with Jerome and then let the others chip in.
There are a few different elements. One aspect I'd like to comment on from this Petrobras situation is that when things get a bit tricky in the world, it's good and bad for us. It's obviously bad because we might have risks in our books and there might be a deterioration in the risks. But on the other hand, it just raises the awareness that people might have to risks that might arise. And so as a result of the deterioration with the situation in Petrobras, we've seen a huge amount of demand for Petrobras cover recently, which is not necessarily something we would have seen in the past, where people would have considered that Petrobras was a great risk and that no insurance was necessarily required. As to Petrobras specifically, I won't necessarily go into details and comment on what the impacts might be, but I'll just say a few words on the way we would approach something like this and how we can prevent being involved with a similar situation. And I think it's something that applies across the board, where we've got risks of fraud, risks of corruption. The challenge for us as underwriters is to have a very good grasp of governance in these different companies and of the political connections that there might be. Obviously, you know, the issues of corruption at Petrobras were hidden from everyone. Would we have been able to know any better? No, probably not. But so governance is a key focus for us and something we pay a lot more attention to right now. There have been a variety of issues in other countries. We've got a case in China right now that's going wrong, where governance was a problem. We've got similar situations in Ukraine and in a variety of other countries. So it's something that we are seeing quite a lot.
From that when somebody somehow has too much access to capital, something goes wrong, if that capital is new. And that's kind of predictable. But I think, and I don't know very much about insurance risk and all these things, but I think the other very critical element is to keep an eye on the cash flow of the company, because if it doesn't generate positive cash flow, something is wrong. And the other important element is adherence to the timetables. Most companies, you can see that something is not quite going right when they start delaying a project after a project after a project. And I think in the case of some of these producers, we have seen these issues where the time schedules were not met. So when you actually see the news, it's too late. But if you kept an eye on the timetables, you know it much earlier.
Fair enough. So we couldn't go, through this event without bringing the election, and we got questions already on that space, and also the Greek funding trouble that we John mentioned in his opening remarks. So the event takes place before, Greece needs to sort that out, this by the end of this week potentially. We have an elections coming up in the UK next week. What are the most concerning scenarios, and what can underwriters do to prepare for this uncertainty period?
Jerome, back to you.
Going back to the one of the points I was making earlier, our focus is really more on emerging markets than on developing economies. So I won't necessarily comment on the UK specifically, but perhaps more on the way we address a situation with upcoming elections in any given country, in any of the countries we deal with, and maybe separately on Greece, I'll make a few points about how we tackle situations such as what's happening in Greece. But so looking at countries in an election situation, an example could have been Nigeria and recent elections in Nigeria. We had, in a way, a very similar situation to what we have in the UK, where it was really impossible to call the election before it took place in Nigeria. And eventually, there could have been a variety of issues. So how do we write business in a situation where the outcome of an election is uncertain and where the governments that will come into power will be in place for a few years? So we could either decide to not do anything until the election takes place, but that's probably not the ideal solution, or we can decide to focus on risks that we think might be resilient. And that's what we tend to do, and that's what we tend to do across the board. So we focus on sectors, on companies, on government projects that we feel will be in the interest of any government, regardless of their political color, to carry out. With business sectors that will develop whatever happens. For instance, telecoms. Will telecoms project be carried out by one government and not by another? Well, it's quite unlikely. You might well have issues with licensing, and depending on who the government is, they might decide to favor one telecoms company or another, but generally the telecom sector will be developed in emerging economies. So it's the type of project we look at. Similarly, we will look at strategic infrastructure projects. So if the idea is to develop specific infrastructure in a specific constituency that's linked to a political operator that is likely to be elected, I don't think that's something we would focus on. We would focus on an infrastructure project that would be likely to benefit the majority of the population of a given country and benefit the general interest. So that's really how we address underwriting business in a situation where you've got an unlikely outcome from a political point of view. Now, looking at Greece, similarly, when you have uncertainty such as what we're seeing in Greece, then we try to take risks that might be immune to any issues that might arise from any type of scenario. And so if we were to look at a scenario where we saw Greece exit the EU, well, what would be the impact? And for us, we then try to look at structures and transactions that would not be impacted. And for instance, we will look at Greek exporters and Greek exporters that might export to the Eurozone, to Asia, to the US, where they will generate income that will be in foreign currency. And even if the Greek company's debt has to be converted into dollars or euros or whatever, they'll be able to have this balance between their assets and their liabilities. So that's what we try to do when we see Greek companies at the moment that have a sole domestic focus. We will avoid doing those because of the too high risk.
Okay. Let me bring Jean-Michel to the panel and ask you two questions, if I may. One is, two questions that I got from the audience. How low do you see the euro going against the dollar? Is it parity a possibility, or will it bounce back to 1.20-ish? And there was another question about interest rates. When do you think we will see or have interest rates around 2 to 4% in the US and in Europe?
Okay, in Europe, yeah, in a long time. I mean, yeah, first of all, on the euro exchange rate, generally what happens is when you look at past QE experiences, and in other words, expansionary monetary policy, the monetary base growing very fast, most of the price adjustment that takes place early on in the process. And so I would say that both for interest rates and for the euro parity, most of the adjustment has probably already taken place. Markets are quick to anticipate the change, and as it was well telegraphed by the ECB, there was no real surprise. Everything came in time and in full. As I said, the size of the program was also viewed as credible and large enough. So, as far as the euro exchange rate against the US dollar is concerned, I think we are at 105, 104. We are probably close to where we will stay, give or take a couple of cents for the rest of 2015. We could hit parity if indeed we have more of an acceleration in the U.S. growth rate than we currently anticipate. I said, the 3% rate of growth this year, a very gradual increase in U.S. interest rates, but that's not guaranteed. We could see the U.S. economy, and we've seen it before. I mean, it would not be a surprise, really, completely, accelerating in the second half again. And on that, leading to expect, quicker, more rapid pace in the increase in interest rates, and as a result, an even stronger dollar hitting parity by the end of 2016. But at any rate, I mean, the message is really, we are in the zone. I mean, we've done, most of the job has been done in terms of the correction on the euro exchange rate. Taking the question the other way around, should we be concerned that the euro could bounce back and become strong again? In my opinion, that's extremely unlikely. It's really hard, and I'm talking about the next couple of years, 2 to 2.5 years. I see the growth differential between the US and Europe will remain in the favor of the US. The interest rate differential will clearly remain in the favor of the US, meaning the US higher rates than Europe. Uncertainties, more uncertainties in Europe than in the States, geopolitical. Excuse me. So I think overall extremely unlikely. Interest rates back to 4%. In the US, probably at the beginning of 2017. I mean, we are seeing a steepening of the yield curve, but it's going to be very gradual, managed. As we heard from Jerome, as far as the exposure of emerging markets to capital outflows, that's a very big issue looking forward. Emerging markets, I'm thinking of countries near us like Turkey or further down like South Africa, depend a lot on foreign finance. Their growth has been financed by inflows of capital. They've had significant current account deficits. And with the change in monetary policies in developed markets, and particularly the tightening in the US, there's outflows that jeopardize growth prospects in those countries. And to a certain extent, we should not be too naive, but to a certain extent, the Federal Reserve is aware of this and of the risk that could derive from too swift a correction in US interest rates. As far as Europe is concerned, in a long time. I mean, this is really a very, very flat yield curve that we are contemplating for the foreseeable future.
Okay, thanks for that. Jorge, one for you. How do you see the development of world steel prices? When will supply realign with demand? And do you see Chinese dumping in emerging markets as an issue?
Well, what the situation has been in primary commodities such as iron ore and steel as its immediate use is that China has been the driving force. China has been building roads, airports, apartments, all of these things. And that provided huge oomph, really, strength to iron ore and to steel prices. That factor is gone for the time being. Supply really exceeds demand at this stage. But the prospect of huge cutbacks in mines and announcements that have recently been made about either companies encountering cash flow problems or real cutbacks in supply have provided a floor to these prices. So right now it's a financial impact what is preventing those prices from collapsing further. The demand, insofar as we can tell, has not improved. So I think that imbalance will continue for a while until the real low prices start modifying behavior. And I think that's going to take a couple of years, if not 3 or 4, for this situation to change. So it's a little bit similar to the yield curve. The yield curve looks kind of flat. Demand looks kind of flat. It will take really 3 or 4 years for that curve to start turning up. So prices, sub 500 for a while for steel, and maybe sub 60 for iron ore, in my opinion.
Thanks for that. Jerome, a targeted question at you. How do you ensure that your insurance prices do not provide buyers with a more competitive or potential arbitrage price than they can obtain in futures and derivatives markets?
I'm not sure I entirely understand the question, but I'll give it a try.
They want a deal from you.
The point with the insurance product we provide is that it cannot be used as a speculative instrument because the insurance we will write will have to generally be linked to a specific trade-related underlying transaction. So there is some arbitrage, but the arbitrage is really for the insured, the entity that comes to us asking to guarantee a specific transaction. And the arbitrage there is between using insurance, using a credit default swap when a credit default swap is available, and that's not necessarily always the case, using a guarantee provided by a bank, or just diversifying their portfolio and mitigating their risks in that way. So as far as this latter arbitrage, that is possible. Do we have any concerns that our prices might be cheaper than what a bank might do? Not really. If we are comfortable enough that the prices we are charging are sufficient for us to achieve our profit targets, that's not really a concern. You know, we could have a concern going back to the former point in terms of using insurance as a speculative instrument, but again, that is just not possible, and that not being possible, I don't think there is a risk of any distortion to any markets from the use of insurance or from the pricing of the products that we've provided. I don't know if that's answered the question or...
We also have microphones if the audience wants to interact, not through an iPad, just let us know. So let's talk about more of a hypothetical question now, right? So we talked a lot about the crises that are ongoing, the known crisis or the latest crisis. But if I were to ask the three of you, what are the potential future crises, or what is the next financial crisis in the making, where would you say are the current risk spots to be watching out for?
Shall I start?
Go for it.
It's obviously hypothetical and difficult, but I think as a macroeconomist, and focusing especially on Europe, Middle East, and Africa, I think that we see that the European Union and the European Monetary Union, that's two different concepts, remain fragile, and probably more so than they were in the first half until 2006. We talked about the UK elections, and here the question that we get asked all the time from non-UK investors is obviously the question of Brexit. You know, will Britain ever leave the European Union? I mean, for that question to be even possibly asked shows you that, you know, we are in highly uncertain times. I mean, who would have asked that question a few years ago? And inside the European the monetary union, the fact that this Brexit, the Greece leaving the European monetary union, which we continue to see as unlikely, nevertheless shows you that the euro is not necessarily irreversible, that the very possibility of leaving the monetary union becomes a real one, which again was not the case a few years ago. That was a purely theoretical, it was a non-question. You're in it and you're in it forever. Well, no, maybe not. So I think those are, and this is a personal opinion, but it would, all those events would take us way back in terms of European history. I mean, the reason why I think that Greece will not be let go as in a company, is more for geopolitical reasons than for economic reasons. I think that after Ukraine, we would have a second country at the borders of Europe, really in Europe, that would be highly unstable as a result of having left the union, or at least the monetary union, where at least for some time the state would be really unable to ensure security and safety and that sort of thing. Obviously that presents for the rest of the European Union a major geopolitical risk. On top of that, if you remember where Greece is in the Mediterranean Sea, I mean, last week's very tragic events are reminding us that there's a big gap in terms of wealth distribution and in terms of stability between Africa and Europe, and obviously having a state, a country that is highly unstable politically and from a security standpoint opens the gate to massive immigration flows that could destabilize the union as a whole, I think, in a significant way. So for all those reasons, I think it is not the most likely scenario, but of course you're never too sure. That anyway shows you that what we thought we could count on or rely on, the union, a certain stability in Europe, institutional stability, that's not guaranteed anymore the way it used to be.
I would have a couple of ideas to throw out for you, and my apologies, Jerome, for stepping in. As an economist as well, one of the things that I am seeing with growing concern is the funding of a lot of the pension plans. In Europe, this is very important because the population is aging, and with the yield curve being negative in many areas, funding is going to start showing up as crisis relatively soon because capital is being chewed up fairly quickly. This in turn puts huge pressure on the central banks to then maybe turn up the interest rate to create a return in effect in some pension plans. But then if the interest rate starts increasing too rapidly, governments will be voted out and people are going to have a huge problem with their mortgages. I think those two things are kind of linked, and for the central governments to find a balance is going to be extremely difficult. And I think we need to be very focused on those two areas. The third one is the Middle East. From where I am and visiting the area fairly frequently into the safe areas, I would say, Dubai, UAE, the big traveling centers, the instability has grown steadily year on year. There's a sense, I guess, in the Western side of the world saying we're winning, and we're winning in more areas than before. And if your area of operations, where you have to maintain peace, keeps on expanding year on year, and more nations are having friction with each other, I would question whether you are winning. But the area is very unstable, and that's a risk.
Just following up on Jorge's last point, I think this is a major concern, and there has been a dramatic change in the Middle East due to a change in the U.S. foreign policy towards the Middle East. you had a sacred pact between the US and Saudi Arabia that had been in place for more than 50 years, and that had really not been touched at all. With the US now being in a way forced to approach Iran and to do a deal with Iran, because it is believed that being able to deal with Iran and having Iran influence any militias that it might be backing in a variety of the Middle Eastern countries that are currently suffering instability, that interacting with Iran will be the key to more stability in the region. But by doing that, you're angering Saudi Arabia, and the immediate result of that was Saudi starting its air raids over Yemen. And you've got this proxy war in Yemen, and you might have others in the region. So instability is probably there to stay, and not only in the Middle East, but in North Africa as well, where following the Arab Spring, it was quite easy for a lot of people to say right away, the Arab Spring is going to bring a lot of happiness to everyone, democratic governments, and it will be the end of any problems, and everyone will be happy. Well, that's not the case at all. The transition with any type of revolution takes a while, and we unfortunately had a pretty dark reminder in Tunisia, for instance, that Tunisia, where some of the issues started, was considered to have resolved all of its problems rapidly with a democratic coalition. Well, the coalition is not necessarily working, and there are a lot of disgruntled people in Tunisia. But Tunisia is a relatively small country, and the impact of it in the region might not necessarily be that important. But you can look at Algeria and what might happen there once the president dies. The president, Bouteflika, doesn't seem to have been able to do much for maybe a couple of years now. You have a very strong army in the country, but will that be sufficient to preserve stability? I think it's quite unlikely, and I think there will be problems there. The Egyptian situation is something that seems to have calmed down, but there are certainly prospects for the situation there to deteriorate again. So those are some of the issues in the Middle East and North Africa. Still from a geopolitical point of view now, you just need to look at Russia and Ukraine. We haven't really mentioned that. From my point of view as an underwriter, we used to do quite a lot of business in Russia. We used to do a fair amount of business in Ukraine. This situation we're seeing at the moment is complicating matters from a variety of different points of view, and that's only Russia and Ukraine. You have the potential for issues between Armenia and Azerbaijan. There's the potential for Russia to destabilize Georgia. So it's hard to pinpoint one potential crisis. It seems that general instability is going to be the norm for a while.
Thanks for that. I think those are very thoughtful answers. And I'll read out probably the longest question we've received so far, but I think it's a very interesting question because it brings it back to Europe. And I think it goes to Jean-Michel says, looking at the debt to GDP ratios, what will happen to periphery European countries when the economy in Central and Northern Europe will start growing consistently? Inflation getting back to normal above 2% and interest rates rising. And it comes with a second question as well. Is the single currency and a single interest rates, because we talked a lot about ECB here and the alignment of the different economies, sustainable for those economies? Or should we think and debate the benefit, or should we think and debate the benefits of a Northern European euro and a Southern European euro?
Yes, as far as the first question is concerned, and the debt to GDP ratios, what has been critically missing in the past few years is inflation. That was, I briefly hinted at that in my presentation when I said that when you look at what the Bank of England did early on during the crisis when it launched its first QE, if you read today the statements and the various presentations made by Mervyn King, at the time, he insisted a lot on the fact that a certain level of inflation needed to be maintained in the economy. And perhaps at the time, people didn't really realize why he was saying, I mean, where he was going with this inflation needing to be kept at a certain level. But in fact, when you do not have any growth on the real side of the economy for a certain period of time, inflation is really the only way for you to improve the ratios as the debt to GDP ratios. And that's what has been critically missing. I mean, we are in negative inflation territories today in most countries in Europe. That's partly because of commodity prices, but also because of the weakness in our economies. So if what will happen when the economies of Central and Northern Europe start growing consistently? Well, we're starting to see this in 2015, 2016. As I said, Germany is at full employment, growing above potential growth. The Scandinavian outlook is also improving again. So we have, encouraging signs here that will gradually lead to slightly higher inflation, perhaps in the 1.5% zone, which is still well below the ECB's target, but it's better than 0 or minus 0.5. That will, to a certain extent, help the ratios. But certainly, the bigger question remains, if you look at Italy and you say, well, we have a ratio of about 130, 140% debt to GDP ratio, how sustainable is this? One thing that debt and treasury officers in the various countries have started to do with, along with QE and very low interest rates, is increase the maturity of the average maturity of their debt. And that's been a remarkable development. I don't have the numbers right in front of me, but I think that even in the case of Italy, I mean, they've been able to sort of almost double the average maturity of the Italian public debt in the recent past by refinancing at very low interest rates over a longer period. The same with Spain. France has been doing that. You know, this is the difference with the UK. In the UK, typically public debt has had a very long maturity for some time. I mean, over 30 years, and it's a very common feature. Not in the Eurozone. And so the fact that they've really increased the maturity means that when we see growth coming back at a stronger level and interest rates increasing somewhat, as I said earlier, we see a very gradual increase in interest rates. To a certain extent, perhaps debt ratios will be more sustainable in those peripheric countries, which and this remark helps me also address the second question, northern versus, a sort of northern euro versus a southern euro. No, I think that that remains quite unlikely. I mean, of course, we've learned during the crisis that what you think is unlikely is not necessarily so unlikely. But for the time being, at least, that's not the trend. That's not what we are seeing in the horizon.
Okay. We have a couple more questions to go, if time permits. But I think this is probably one of the best questions of the day. Why does the stock market seem to be uncorrelated from economic performance, right? So we've been seeing FTSE levels and New York Stock Exchange levels reaching record highs. And in this presentation, the whole morning, we've been talking a lot about the macroeconomic risks, the political risks, instability in the Middle East. Isn't this dangerous?
The stock market is not correlated with the economic cycle, it is correlated with the monetary cycle. That's very clear. Do a chart, or have someone in your team do a chart, very simple chart of the balance sheet of the Federal Reserve and the S&P 500, and you will see that the correlation is almost perfect. When the balance sheet increases, you do have a major boost on equity markets. That's exactly what's happening now in Europe as well. Mm-hmm. And of course, there are always this exuberance sometimes irrational exuberance that we heard of before. Yes, I mean, equity markets tend to overreact. I mean, we know that on the way down, on the way up. But it is clearly, to me, a liquidity development. Of course, there's a lot of pent-up demand. I mean, we are now seeing an improvement in the economy. I'm not saying it's totally decorrelated because monetary policies help the real economy, of course. But if you are looking for a closer correlation, something that more short-term, I mean, that's really the correlation that explains the performance of equity markets, in my opinion.
And let me add another thought there. In a market, in a financial market, what you're looking for is yield and capital gain, in effect, right? And there are various vehicles to avail yourself to yield and capital gain. And when there is a surge of liquidity, some of that extra liquidity then will go to the stock market to look for either a dividend or a rise in the stock price, and it's yield and capital gain. So monetary policy is the driver, absolutely.
So let me go back to China then. We've got a question here that says, will China's more aggressive foreign policy in the South China Sea impact on the growth potential of the whole region or the Asian region?
I used to live in Singapore. I grew there. I was there actually for 10 years running Platts operations there for a while. And what I learned, I married a lady from Singapore as well, is they're practical. There's the political side, and then there's business. So I don't think it will impact at all the economic performance. If anything, it'll be seen as a way to do business, right? You have to build roads or airports or whatever it is that you have to build. It's just business. So don't worry about it.
I also think that we should perhaps remember that China's goals are not to just have a foothold in any country around the world from a political point of view. It's more, as Jorge was suggesting, more pragmatic. And China has never really had an expansive foreign policy. I think when we look at China, it's too easy to think of the way that European countries might have behaved with colonial policies, or the way the US might have behaved with a variety of military bases in a bunch of countries around the world. I really don't see that China's foreign policy aims to replicate any of this. It's really more securing commodities that might be needed, developing specific markets, and making sure that other countries might not expand too much and encroach onto its sphere of influence, rather than China being aggressive.
So sticking with China, maybe Jerome, you can help us with this one. What is your view of the short and middle-term default risk in China, particularly for state-owned enterprises, in the light of the recent bond default of Baoding Tingwei?
A few of us were in China all of last week, and we got to meet a variety of different companies. One of them had some state involvement. The others were private. And we were able to have discussions with the commodity trader in particular that deals with a variety of different counterparties in China. Very clearly, what they're seeing right now is that they're seeing a relatively high level of default from relatively small companies. And so that's not something that would make the press. It's not as high profile as the recent bond default. It's not as high profile as the Qingdao port matter, but you do have a lot of defaults, and this is something that the commodity trader we were visiting with in particular was telling us that they're in the process of discussing with Sinosure, Sinosure being their credit insurance company out there, and Sinosure generally see a variety of default from other entities they deal with as well. So there is a lot of that, but will those defaults be of a magnitude sufficient to trigger any panic in the Chinese market, to trigger anything that would be particularly concerning? Not necessarily. It's more a matter of cleaning up the Chinese system. And that's what seems to be happening from a political point of view by either rooting out corruption. In some cases, that has an ultimate political goal, but at the same time by allowing some companies to default. So do we have any major concerns from that? At this point in time, not particularly. It seems more healthy than anything else. Going back to another point that was made earlier, one of the justifications to the defaults that are currently happening in China seems to be related to the fact that capital was widely available, is still widely available, and what happens is that you have a variety of companies, in many cases family-owned companies, that have been able to attract this capital and that are not able to only use that capital to develop their core business that they're very familiar with, but they're just going to use it to go into all sorts of different ventures and invest in the Chinese stock market, invest in Chinese real estate, and that's where issues come from. When that deteriorates, the core business of the company is no longer sufficient to prop up the business, and you end up having a default.
Thank you so much for that. Jorge, Jerome, Jean, that's all we had time for today. I couldn't thank you enough for the time you spent here with us today. Thanks for the audience for coming.